To our panel here for some reaction as well. So we still got Steve Sosnick and Ohsung Kwon with us. Ohsung, I want to go to you because you did do some work. You touched on it a little bit just a few moments ago, but you did do some work looking at the financials and previewing the banks ahead of earnings kicking off with them tomorrow. And one of the takeaways for me is the fact that you don't think net interest margin could be quite as big a driver for stock reaction as book value is. Why?
Yeah, so our call is you want to own rate-sensitive cyclicals now that an easing cycle has begun. And I think banks really fit that narrative. Not that their earnings were hit by the hiking cycle over the past 2 years, but their stock reaction was still pressured by it. And the biggest reason was the banks didn't really trade on net interest margin or EPS. It traded more on book value. And lower rates means higher book value in general for the banks. So if that's the case, this easing cycle should be more favorable for the banks going forward. Also, we see that the rate-sensitive side of the economy that were hurt by the hiking cycle over the past 2 years, those could potentially come back in 2025. And the sectors that I'm watching are really manufacturing and housing. I mean, a lot of people are talking about how this hiking cycle didn't really have an impact on the overall economy, which is true. If the economy is 70% services, 70% consumption, which was really helped by all the physical stimulus. But if you look at underneath the surface, manufacturing and housing, those really rate-sensitive sectors, they've been in a recession. And the real bull case for the banks is if those sectors start to come back in 2025, given that we are in an easing cycle, that could potentially translate into better loan growth going forward. And if that's the case, that I think is the real bull case for the banks.
Okay, so Steve, you mentioned earlier that the market's been reacting to macro data kind of the way it wants based on the way things have been trending. Do you expect something similar to guidance in this earnings season? Are we going to learn something about how investors react to the guides?
I think that's really yes. I think that's an absolute yes, John. I think the key here is we saw it today in even something like Domino's Pizza, where they beat numbers and the stock didn't really do much because they didn't really have great same-store growth. In an environment where 75 to 80% of the companies beat their published estimates, people look beyond the estimates now. People have gotten smarter about that. They're a necessary condition for a post-earnings rally, but not a sufficient condition because people are looking past that. And in a situation where, yes, this quarter, as Ohsung said, we're looking at about 4%, top 4% earnings growth. That's achievable. Next year, we're looking at 15%. And that anything that punctures that narrative is going to be problematic for the stocks that puncture it. The first situation we'll start to hear from are the big banks. Do they see the type of environment where their big corporate customers and their consumer customers, are they at all constrained by these rates, or are they still continuing to borrow and lend? And then secondly, as we get into more of the heart of earnings season, what are companies saying? Can they achieve the robust guidance that is priced into it? Or will they have, if they pare that back, that might be very problematic for the market. It's very important that they meet and potentially exceed published guidance.